So we want to look at these two consult questions and see how far we've come with our understanding. So it says that the following financial statements of Papa, Tata, and Chebi, all PLCs, as at 31st March 2017. So we have the Papa, Tata, and Chebi. We have the information. Investment in non-current asset is there. So we have this. And in Chebi is also here. The current assets are here, so it's together. We have equity, share capital. These are the capitals. We have share premium. Revaluation reserve is only in Papa. Retained earnings are here. Total equity is there. We have non-current asset put together in their line, and non-current liability and current liability. Then it says that Papa acquired the following shareholdings in Tata and Chebi. And it says that these are the dates. All right, the holdings, fair value of net asset, these are the purchase considerations. On 1st April, these are what you have. All right, so that is that. And you are also provided with the following information, which will be relevant to the consolidated financial statement of Papa PLC. We have none of the companies has issued additional share capital. That's what they said as at 1st April 2014. Then the financial statements of Papa have not yet been adjusted for the gain or loss arising on control. So it means if there is such, we need to do it because they have not done it. We have to do it. And it says that on April 1st, 2014, the carrying value of the net assets of Tata were the same as their fair value, and the value was 325. That is on 1st April 2014. Papa PLC wishes to use the full fair value method. And I think you know that goodwill has two methods. We have the full, we have the partial, or the proportionate. And so here it says that it wishes to use the full goodwill method for the acquisition of Tata. And at April 2016, the estimated value of goodwill attributable to the NCI is 3 million. Of course, if you have watched my video on basic consolidation, I treat attributable goodwill. I've explained it. The estimated fair value of the initial investment in 30% of the shares of Tata was 150 million as at this date. All right. So it says that included in the tangible non-current asset of Tata was a land, and the land, as you see, is valued at cost, which on which March 31st had a fair value of this in excess of their carrying value. There has been no significant change in that. So you know that these are your fair value adjustments. At April 21st, that one to the fair value of Chebi's land is 60 million in excess. All right, so that is that. So goodwill arising from the acquisition, it says that is to be tested for the impairment. And as at the year end, the impairment was 50 million. And so 50 million is recognized for Tata. There has been no impairment. So just to draw your mind to this. So as you have seen this, when you go to question 7, you realize that it is the same thing. Actually, you could see clearly that it's a lifted question ICA did. All right. So you read question 7, is the same thing. Figures are the same. Percentages wise, a little, these figures are the same. You saw it the same. And you saw this one, they didn't write anything of there has been no issue, but it is implied. So you have this same figure there. You saw it in the notes that I read. And the estimated fair value is 10%. Initial, they made it 10%. Then they adjusted something small, all right, that they uses the full goodwill method. And here the NCI. So you realize that they didn't make it the attributable goodwill. So this one, they said that they estimated that the non-controlling interest was 95. All right, so that is that. The non-controlling interest is 95. The difference, blah, 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 everything here is also 25 in excess, all right, on these dates. Okay, the same thing. So you will come back and apply the same concept of whatever we will do on that question 7. Practice it, do it. All right. So coming back to our question, which is our question 15, we now need to start doing the question. Now, when you are solving any console problem, you know that IFRS 3 says that we should do acquisition accounting, and that is what you are going to do. Acquisition accounting is applied when control is achieved. So anytime there is control, then it means that you will need to actually do your consolidation. All right. So that is that. Okay. Now, so we start with our workings. Our workings 1. Our workings 1 is group structure. Workings 1 is group structure. So we are going to look at the information that we have to be able to draw our group structure. It's marked, so you have to do it because IFRS 3 is a standard. So you do group structure. Here we have the parents being Papa. All right. And per what we have here, you will see the purchase. We have Papa buying Tata. So Papa, this is it. Papa acquired the following in Tata. And so we have first one, Papa bought Tata and on this date, and he bought 30%. So that is that. He bought 30%. So this is Tata. And he bought it on 1st April. All these things must be shown. 2014. He bought 30%. That is what we see. As far as this is concerned, we don't consolidate because this is an associate relationship. So there is no consolidation to be done as far as this is concerned. But we also see in there that in 2016, April 2016, this same Papa bought another 50. And this is what we call a step acquisition, meaning that as at 2016, he has 80%. As at 2016, you could see clearly that. So that is that. And we do consolidation only when we have control. So the consolidation of this will start at 2016. Take note of that. Then we also see that this same Papa also acquired another one called Chebi. So you see in here that from the day we are doing the consolidation to our reporting date of the question, which we are supposed to prepare to 2017, from April 2016 to 2017, you must also indicate the year, which is 1 year. All right, that period is 1 year. When he bought Chebi, the question tells us that Papa has acquired 25% of Chebi. So 25% of Chebi. Which date is that? That one too is April 1, 2016. And the what you see from that year to consolidation period is also 1 year. All right. So that is how you draft your relationship within the consolidation. Please, at this point, I want to pause. If you have any question, you can ask right now. If you have any question on what we've done so far, you can ask. So this one is not a D shape, neither is it a vertical shape. It is just a consolidation and a one subsidiary and one associate, but it's just that it is a step acquisition. All right, it's a step acquisition. So that is that. We don't have any information anywhere here again where there was a purchase. So you use all the purchases information to do your workings 1. All right. So that is that. Any question at this point? Any question? So I think somebody like was it who said he tried this question? Andy Rich, were you able to draw this?
Yes, sir. I did
All
it
right.
the other way.
What other way?
So the structure where you put Tata and Chebi there, and that table, like a table form.
Oh, okay, no problem. The most important thing is that you get it correct. All right. I prefer the drawing. All right. So now we go to our workings two. Workings two, what do? We do fair value of net assets of the subsidiary. In this case, our subsidiary is Tata. And so we are going to, the 25% doesn't amount to subsidiary, it is associate. So you apply the associate equity accounting, IAS 28. This one we are doing for the subsidiary is IFRS 3 acquisition accounting. Get to understand those things from the basic consolidation. So I would advise that if you have not watched the videos on that, kindly do. All right. So at acquisition, at reporting, then we have post acquisition. The format you use to do this, yes, Andy Rich.
So please, since you said you are using this on YouTube page as well, I think if you can add the reporting, I think you stated the dates of acquisition and the control, but you didn't touch on the reporting.
Is which reporting?
That is date of reporting, where we can be able to identify the period of consolidation.
I don't
The group
understand your
structure.
question.
The group structure.
You want me to do what at the group structure?
You see, you have indicated 1st April 2016 to be the date of control. But the reporting and
You
the
don't need to
period you
show
stated 1
reporting.
year.
You
Okay.
don't need to show the reporting. I'm just showing you from that day we acquired the company to the day we are doing the reporting. The reporting is the requirement of the question. This is it.
Okay.
So from 2016 April to the date you are doing your requirement is the 1 year that I've shown. I don't need to write 31st March 2017 there anymore. It's not necessary.
Okay.
Yeah, we just need the year. And the reason why you put the year there is because of fair value adjustments. That's the only reason why. IFRS 3 never said we should write. And that is why I'm saying get the basics correct. IFRS 3 says that 1, identify the acquirer. 2, the date of control. It never asks us to write reporting date. So I get it. Some tutors teach it, but I do the standard. Okay, is the requirement I follow, is the law. All right. So that is it. IFRS 13 never said, 3 never said we should show reporting date in workings 1. It never said that. It never did that. You can get the document and you can even verify. All right. So that is that. Now, the workings 2, the structure you need to use is your accounting equation. That's the format you need to use. The accounting equation using the equity definition, the second order. Now, it means that start with the things of your equity. If there is any fair value adjustment on these two, then you will include. That's the meaning. So we start with our stated capital. What is our stated capital? You come to here, your equity side. All right. So you have to be very, very, very careful. So we have share capital. How much is it? You realize that the share capital, you are looking, this is in Tata's book. So look at Tata. Share capital is 240. 240 at reporting. Now listen, the question says something. It says that none of the companies has issued any additional shares since 1st April, which means that the capital that has been there since 1st April is the same thing throughout. You have to understand that. That is the meaning of that note. So it was 240 and it has been 240 throughout. So it means the difference is 0. Don't forget, it is this side minus this side. The arrow is like this. All right. So that is that. After share capital, you come to share premium. So we pick share premium. Now the share premium for this guy is 20. of course, that one too, if there is no issue of shares, hardly will you have that one too changing. All right, so that is that. Then the next thing is risk valuation reserve. There is nothing there, so we can leave it. Then the next thing is retained earnings. So we have retained earnings. The retained earnings, the figure we see here is at reporting. So retained earnings at reporting. We are not giving retained earnings at acquisition. So sometimes be careful. If you are not giving retained earnings at acquisition, then the examiner will always give you the fair value of the net asset. He will always give it to you if he didn't give you the retained earnings. So he will always give it to you. But also beware of any adjustment. Do it before. So for example, if you look at this question carefully, the fair value of the net asset, have you seen it? The fair value of the net asset at acquisition. What is at our acquisition date? The day we are consolidating, 1st April 2016. So have you seen the fair value of net assets at 1st April 2016? He has given it to you, meaning that that figure that you want to total here, at the end of the day, you will get here, has already been given as 460. So if he gives it to you like that, then it means that the retained earnings will never be given to you. You have to find it. But before you find the retained earnings as a difference, you have to make sure that you have done all the necessary adjustments in your workings too. So if you look at this one, it's 2014, it's not for 2016. If you look at this one, it's goodwill. So we will use this to calculate our goodwill. If you look at this one, it's tangible asset fair value adjustment. So it means you have to bring in your fair value adjustment. And the fair value adjustment in respect of Tata is such that it has an excess of 25 million. So you know what you do to your fair value adjustment. Fortunately for you, this is a land. Land doesn't depreciate. So if you have 25 as your excess, 25 as your excess, it didn't change. There's no fair value adjustment. So now that you see, then you check this one too is a fair value adjustment in Chebi, which is the associate. Then this is goodwill. So it means that everything in workings 2 is being dealt with. That's what you see. So you have to be very, 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 very careful about the notes. You must endeavor to deal with all the notes. Deal with all the notes. All right. So that is that. Now, can you do the total for me, so that we can find our retained earnings at acquisition? Rich, were you able to discover it like this?
Yes,
when you were doing it?
175.
So 175. Good. So what is the difference here? So this
35.
minus 35.
385.
You said what?
35. It's 35.
All right. So what is the difference here? So if here is 35, then here will be like 495. Because if you add this to this, you have that. So that is that. That is your workings too. Please, any question at this point? Is there any question at this point? That is what you have as your workings too. Any question at this point, please? Any question at this point? Is there anything you don't understand at this point? Any question? So this is where we are. All right. Now, then normally we should go to our workings 3. All right. We should go to our workings 3, and workings 3 is goodwill. Workings 3 is goodwill. But what you need to understand is that this guy had 30 before and he bought extra 50. So when you are doing your goodwill, workings 3, this is a step acquisition. So you need to know how goodwill is done. Now, it's a step acquisition. So your purchase consideration will become 2. So you do fair value of previously held interest. The previously held interest. And they told us that the 30% he had before as at the date they are having this acquisition, the 30% that they had is 150 million. Before, that 30% was how much? 120. Have you seen it? Now,
Yes.
its fair value is 150. So you have 150 million. Don't forget, everything we are doing is as such, like we have it in millions. So that is that. So normally, you have to let the examiner know by actually putting the so you do something like this. All workings are in millions. So you have to show it. All right. So that is that. Then you bring in the fair value of the additional interest. The additional interest that they have done. The additional interest. What is the additional interest? How much did they pay for the 50 that they did? They paid 260,000. So you do 260,000. That is what they paid. So the purchase consideration includes what they had there before, plus what they have topped up. So their total purchase consideration herein is like 410. Ejakwa, you are writing on my screen. Kindly check your machine, please. All right. Now, that is it. When we finish this, what do we normally do? NCI at acquisition, is that not it?
Yes.
And this one, the NCI at acquisition wasn't. Oh, who is writing? Ejakwa, please, you are writing on my screen. Please. All right, let's move on. Now, the NCI at acquisition, you could see clearly that it's either the fair value method or the proportionate method. Now, in the question, we weren't given the fair value for the NCI, so definitely it tells you that you are using the proportionate method. So your NCI here will be 20% because 30, 50 is 80%, multiplied by 460 here. So somebody can do 80% straight because when you do this, we are coming to less fair value of net assets at acquisition, which is the entire 460. So somebody can decide to do 80% straight from here, and that is that. So what will you get from this one?
92.
92.
Yes, please.
All right. So then what is the goodwill at acquisition? What will be the goodwill at acquisition? I hope we are all with calculators staying focused on what we are doing rather than
42.
just
42.
It's what, 42.
Yes, please.
All right. So that is the goodwill. Now, you need to understand from basic consolidation that anytime you use proportionate to value your NCI, the goodwill that you get is for who? Yes?
For the parent.
For the parent.
Yeah.
But you read in the question that they said that Papa wishes to use full fair value method.
Fair value.
But he didn't give you the fair value. And because he wants to use the fair value method, and this goodwill that you have obtained is only for the parent, he decided to give you the goodwill for the NCI. And that is what he gave you. He said that the estimated goodwill attributable to the NCI is 3 million, so that you can get the full goodwill. So that is what you see there. So attributable goodwill for the NCI is 3. So your total goodwill becomes 45. Now, see, and like I always say, it's only someone who has decided to buy this book and is probably not following it page by page, that person, this one will elude the person. Because if I pick this book and I do control find, attributable goodwill, you see one here. This is the question solution. So you should see, did I spell it right? Because you should see this thing in your basic consolidation in your book. And those of you who have also watched the video, you realize that I've explained this thing. It is right from basic consolidation when you start afresh, and where I teach the workings, what you do step by step. You see, these workings, there are so many things that can happen. This one is something that you have not seen yet. In the question 14 that we do, it is there. Then you will see workings 2. For example, you have something like what do you call it? Fair value method, and what do we call it? The full method. This thing, wow, I'm not seeing it here anymore. That's serious. This is it. Attributable goodwill. Goodwill allocated when proportionate method is used only. But I think it should be part of your workings 3. I don't know if that guy took it out. It's supposed to be there. It's part of workings 3. Those of you who have the old book, you can check. Yeah, you can check. It's supposed to be part. Because I normally, even my FR book, I teach that thing in FR, so I always add it there. Yeah. Quite unfortunate I'm not seeing it here. It's supposed to be part. If you have the old book, check. You can check. That is something that I need to check here. Because in the workings 4, you see that I've brought it in here. It's part of the things that are there. So I don't know. So Andy, did you add it to your workings 4? Were you able to see this?
Yes, sir.
You added
Yes,
it?
sir, but I did it differently. After getting the what do you call it? The 92. I added it before deducting the 460.
What you are doing is just mathematics. It's not that different. It's just mathematics arrangement.
Yeah.
When you add this to this, it's the same thing. But be careful, because it's an attributable goodwill. So you need to find your goodwill first, and you add.
Okay.
So, but it's just that it doesn't make anything wrong. It's just mathematics. If I say 260 plus 150, it's the same thing. It doesn't change anything. It's nothing different. It's just arrangement of mathematics. All right. So let's go back to our question. That's question 15, right? Okay. So we are here. So that is that. And they told us that goodwill has been impaired, and the impairment on goodwill is, how much was that? Impairment of goodwill is 15 million. All right. So impairment. Impairment of goodwill is 50 million. Now, because if there had not been any goodwill for the subsidiary, the impairment, for the associate, NCI, the impairment would have been attributed to the parent only. But now that you have allocated goodwill for the NCI, impairment is supposed to be shared. Now, you need to pause here before you go to your workings 4 and do the gain or loss. You have to do all gains or loss. Now, watch this. Before you combine this company, the guy had an associate. Don't forget that. When you combine his 30%, previously, his 30% purchase was this, 120. That's the value. So you are doing the gain or loss on fair value change. You have to be mindful of that. Now, the gain or loss on the fair value change, what you realize is that before the fair value before the step acquisition was 120. That same interest that he had, it changed. Fair value after at step acquisition for that same interest changed to 150. So it means that IFRS 9 will even tell you that there is a gain on the acquisition that has been done. So you see the difference is 30. It's positive, sorry. The difference of 30. I don't know if you were introduced to this too on step acquisition. Now, so this one is a gain, which is supposed to go to our workings 5. It's a gain that goes to the SPL. So since we are doing balance sheet, retained earnings is the representation of our SPL. But also you need to realize that as the person has sacrificed his associate interest now, it is gone. So if you know the word realization, when something is exchanged, it is realized. When something is disposed, it is realized. So this tells you that he has given up his associate. He has given up his associate. So when he gave up his associate, what happened? You can decide to treat it together with this fair value change that we have done. You can decide to do it like that. You can also decide to do it differently. So I'm going to do the two cases. You pick which one you want to use. Now, watch this. In the same gain or loss that is happening, we can say that the new fair value is 150. So when he is realized, the associate realized, because he had 30%, he's giving up that associate. He's giving it out. So what you see is that he had an associate. Now, like I said, you can do it combined. You can combine the two and do it. You can also decide to do it separately. Whichever way you want to go about it is fine. Or let me take from Andy. You are the one who solved the question. Did you do something like that? Did you do something like that?
Yes, sir.
So,
But later on, I got confused in a way, because when I think Sebe taught us, the gain and loss comes in when it is this particular 30 is when it is about trading. When the first acquisition is less than, let's say, 20%, and the thing is trading. But because I realized that it is not trading but investment in
trading,
associate.
what do you mean by trading? Is it IFRS 9 tradable instrument you are talking about, or what do you mean by
He
trading?
means trade investment.
Yeah,
that's IFRS 9 fair value
yes,
to
yes,
PL.
yes.
And now that's
So
the one we call trading.
I ignored this one, and I did the other one. So I got -3 as loss on the I called it reclassification of adjustments. So I got -3.
Yeah, I think
But
that's
you
fine.
go ahead and do the second one.
It's fine. It will be fine. It's fine. You can do that. Because if I take the fair value, which is 150, and I decide to deal with my interest, because it is my interest that I'm giving up. The cost of my interest is 120. But aside that 120, I have as you deal with associate all the time, you do purchase consideration of associate. That is what you do. Then you do the CI share of post-acquisition earnings.
Acquisition.
Yes.
Yeah.
So that is what you do. So the CI share, what you're going to do is that the CI share is 30% as when it was an associate. Then you multiply it by retained earnings at disposal minus retained earnings at acquisition. So that is what you do. Is the thing we do in acquisition associate. So if I want to know, so you do retained earnings at end, which is the disposal time, and retained earnings at acquisition. So that is that. Now, how do I do my retained earnings at end? Because the retained earnings, we were not given. We are, you see, this is the time he bought the thing. This is the time he bought the thing, and no retained earnings was given. That is 2014. So the retained earnings at acquisition must be calculated for. It must be calculated for. Then again, you do find the retained earnings at end. The end is when he became a subsidiary. He moved to become a subsidiary. So the retained earnings at the end is actually the 175, the one that you have found, because it is on that day he became he rendered over his associate to become a subsidiary. So we need to find the retained earnings at acquisition date. How do we find retained earnings at acquisition date? It's simple. The same thing you did to find this retained earnings, the same thing you will do. So, for example, at the date, that's why the question said that there has not been any issue. So, if you want this particular one, this retained earnings at acquisition, then it means you will need the stated capital, which, of course, since 2014, it has been the same in Tata. It has been the same. Nothing has changed. It has been the same. But you could see clearly, you see the retained earnings here, right?
Yes.
You saw some retained earnings here. This retained earnings is at the reporting date. We will use this one too later. Now, watch this. So we know that finding retained earnings in this question, when we were doing you realize that this retained earnings is at reporting. The reporting is 31st December. Now, the at end for this guy is the day 1st April 2016. So you can't use this. This is 31st December 2017, March 2017. You can't use this. So at end, which is the day he became a subsidiary, is the same as the end for the associate. All right, at the beginning of the subsidiary is the end of the associate. Then you find at the date, which is 2014. On 2014, the stated capital is the same. It's 240. Share premium is the same, which is 20. But you saw that there was a fair value adjustment. That fair value adjustment never existed when it was an associate. It existed when he became a subsidiary. So that is it. So that is what happened. It existed when he became a subsidiary. So you realize that in this question, you were given the fair value of the net asset. You see this? Fair value of net asset at acquisition. So when you acquired the 30, which is 325, which means that the difference that you find there becomes your retained earnings. Is 325.
65.
So the difference that you get there becomes your retained earnings. There was no adjustment at that point. No adjustment. So that is what happened. And so what is the difference?
Negative 65.
Negative 65. Is it negative or positive? I think it's positive.
Positive.
Yeah, I don't think it's negative.
Yeah, so it's positive.
Yeah, positive, brother.
So 65. So you see, it is 75 now minus what? 65.
65.
And you strike your 30% on it. What will you get?
It is the 175 minus 65 will give you 110. So 30% of 110 will give you the 33.
That's the 33. All right. So like I said, so your 3%, your 3 that you had, negative 3 that you had, is between this one and this one.
Yes, sir.
That is where it is coming from. So you can decide to show it either way. So you see that I brought the 150 and I brought the 120. If I am doing it together, then I can say that this one is 153, right? And so my figure here will be the negative 3. That is what you had. So you can choose to present this one. You can choose to present this one too in your workings 5 and this one in your workings 5, so that you get your negative 3. Don't forget, this is a loss. This is a loss because that is what you are giving out. You are losing that. So if you put all things together like this, you can get your negative 3. So when you go there, you can just put in only the -3. Or you can decide to put 33 cost. It's a cost. It's part of your cost. And 30 gain. At the end of the day, it's still -3. So like I said, it depends on you. All right. It depends on you. So that is that. That is that. So that is how you work this. So when we get to our workings 5, let's make sure we bring these things. You see, guys, the truth is that if you don't take your basic side serious, this thing will look like a movie. Yeah, it will look like a movie. All right. Any question at this point? Before we go to workings 4. Any question at this point? Then, Andy, why didn't it balance? It looks as if you are getting everything correct. Why didn't it balance? Where did you miss anything? So let's do the workings 4. Let's see where you missed up anything. Workings 4 is NCI. How do we do our NCI? NCI at acquisition, right? And what is our NCI at acquisition? We can always refer this thing from our workings 3. NCI at acquisition is 92. All right. But like I always tell students, the moment you do your goodwill, go and start your balance sheet. The moment you do goodwill, quickly, just start the balance sheet. Just do it. So here we have Papa Group. Then we have statement of financial position, or you can say group statement of financial position, whichever way you want it. Statement of financial position as at. We are doing it at 31st March 2017. Don't forget, it's only one currency. All right. So you start goodwill coming from your workings 3. Because your workings 2 is done. So there is nothing that will come in harm. So what do we have? What did we get for our goodwill? 30, right? So you slot it 30. Then we have our tangible NCA. Tangible NCA, let's combine them. Please pick calculators. Let's start the combination. Plus 440. Is there any fair value adjustment in workings 2 we need to bring in here? In workings 2, yeah, there is 25.
Yes, the 25.
There's a 25. So let's just add it and get us the figures quickly. Then we have investment in Tata. Now, the investment in Tata that you see, the 413, you can see that it knocks off. It probably knocks off itself. So you realize that this is it. Purchase consideration, we have 410. You see, this is 413. There is an extra 3, the 3 that we've lost, the loss of the 3. Have you seen that? Have you seen that in the purchase?
Yes, sir. In the purchase, yeah.
Yes, that is it. That's the loss of the 3. So it makes this one equal.
413.
Equal. So in fact, even from here, you could see that we are 410 and here is 413. And the guy has lost something, which is the 3. Even from here, straight. Just do just via the comparison between this and the figure that you have here. You will see that he has lost a 3 that is going to be against his retained earnings. That's the shortcut to it. That's the shortcut to it. Because of the step acquisition. So that is basically it. All right. So you could see clearly he has lost it because the first purchase consideration this is it. And this one became 150. So you could see clearly that the loss has happened. So that is that. And it cancels off that investment in Tata. So we had an associate in this question, so we need to think about investment in associate. Anytime you have an associate, it will be part. So we will go and work it out. And normally, if there is associate, that should come from your working six. We will do working six. All right. Then we have CA, current asset. The current asset we have here is 531 plus 190. So if there is any other thing we need to add from the adjustment that we have, we will bring. But you read everything. Did you see any other adjustment affecting carrying the current asset? You didn't see anything like that. There wasn't any intra-group, this, that, and all those things. So you really don't see anything like that. So you can close it so that you can earn your marks even without completing the workings. Because if you say stop work, you have written some things. Like I always tell students, if you think you cannot do anything at all in console, anything, you can't do anything, just combine the figures. Please, we don't consolidate associates. We don't add associates. But you can add it. So those ones that adjustment didn't affect, you get your tick for it. Like I always say, it is better than losing that one mark. So you did this headings, you get 2 ticks from Papa Grouper to the currency sign. Then the ones that you add, those ones any adjustment didn't affect, you may get a tick for it. All right, so the current asset, nothing affected it. So please give us the figures. All right, let's be fast with it. Give us the figures.
The tangible NCA, we have 1745.
1745. All right, so we will work this one and bring. So the current asset.
That's it. 721.
Is what? 721.
21.
All right, so that ends our asset part. Don't forget, balance sheet is asset is equal to capital plus liability or equity plus liability. That's what you do. So when you get your asset part, total it down. So that is that. All right. So there you go. So we will have to work the investment in associates, then we will come. You know that, for example, when you come to the equity side, you know that the stated capital, we record parent side only. So don't waste time. There's no adjustment for those ones. So you come and just write share capital. You write share capital. The share capital is straight 800. You write it. Nothing affected it. Share premium. Nothing affected it. In fact, 150, right? Then reserve, revaluation reserve. Nothing affected it. In fact, we could have done something about the revaluation reserve. I just took a shortcut. Yes, we could have done something because in the notes that we have, there was they told us that
fair value land.
There was a fair value something.
Land.
Yeah, the land. It was a revaluation. So if you did that, it means it won't appear in your workings too as we did it. So consult is by understanding. So since we use that approach, we are just going to record the revaluation reserve that is here as 90. You see, there is no adjustment affecting anything here. Why waste time? So the next thing that is there is your retained earnings. We know that retained earnings will come via workings 5. We know that. And after we are done with that, we know NCI 2 will come via our workings 4. Have we done our NCI already? I think we've not done that. So we pause. Then you do your NCL. NCL here is together. The NCL is together. Nothing. So you just do 640 plus 30, right? And that is like 690. Even if you write and something affects it, you can come back and cancel it nicely and rewrite whatever affected it. So there is no need to waste time. And of course, when you finish this part, you must total. You must total it. Then you come to your CL, because asset is equal to capital plus equity plus liability. Each one of them must be total. Then you have CL being 214 plus 130. you can have it. If anything affected it, you can come back and cancel it nicely. Nothing will kill you. Nothing. So what will be this figure? It's what? Is it 244? Hey, no,
344.
I think there's 130. It's 344. So I've done these things down. The rest is to fill in the bracket with the remaining notes that I will do. That's all. That's all. You don't need to waste time. There is no need. If I'm not able to do anything else, I'll have tick for this, tick for this, tick for this, tick for this, tick for this. And I did my good role. I mean, you can have ticks. That's all. That's all. So now we come to complete our workings for NCI at acquisition. What did we get? NCI at acquisition was 92, right? So that is that, 92. When you finish, what do you normally add? NCI share of post-acquisition, right?
Yes.
Yes, sir.
And the NCI share of the post-acquisition, now the NCI is 20%. The post-acquisition was 35, right?
Share of post-acquisition.
Yeah, it
Yes,
was
sir.
35. Then you have the
Yes,
attributable
sir.
goodwill, the goodwill that was attributable to him alone. The NCI. I showed you where it is in the, and I think in my basic console video, that attributable goodwill is actually done in the working tray. I think it's there like that. So now the attributable goodwill was 3. We are sharing this thing because we will share the goodwill impairment because the thing became full goodwill method. So the impairment, yeah. So what?
Yeah.
Give me the figures. Start giving me the figures. So impairment is 20% of 15, right? The impairment was
That's 7.
that's 7. What about this?
No, I mean the earlier one. I mean for the NCI of the share of the post-acquisition, that's 7.
All
The
right.
other one will be 3. Impairment will be 3.
Impairment will be 3. 20% of the 15 is 3, right?
Yeah.
All
Yeah.
right. So now that is it. So what will be our NCI? So NCI
99.
99. Immediately we get 99. We don't need to waste time. Go and slot it there. That's all. 99. Go and just write it there. Then we are coming to do the retained earnings and the investment in the associate because it was Chebi. All right. So that is it. And we do that together. Do that concurrently. Do it together. So you have workings 5 and you have workings 6. Do it together. Because where you have group retained earnings, so here, don't forget, group retained earnings. This one is investment in associate. Now, where you have the parent earnings only, you have the parent earnings only. You start with the parent earnings only. So where you do parent RE here, retained earnings only, here you will do purchase consideration. So that is what you will do. So you know your purchase consideration. You know it. So let's just put in the figures quickly. When they bought the associate, they paid an amount. So you just pick the figure, you slot it in there. So now the group retained earnings, as we can see, is 390. So the parent is 390. The purchase consideration they did for this associate is here. Tebi, they bought 25%. And this is the purchase consideration, 60. That's all. Then where you do CI share of post acquisition, which is now 80% of the 35, right? Here you do CI share of the same post acquisition, the same thing. So CI share of post acquisition in the associate, the same thing. It's just that here you know that it will be 30%, 25% they have, multiplied by retained earnings at the end minus the retained earnings at the time he bought the associate.
Acquisition, yeah.
Yes. So that is what you are going to do. So this one is the same thing you are doing here. You realize that even this 35 that you have, you realize that it's coming from retained earnings. So there's no difference. Do the same thing. This 35 that we are sharing, is it not coming from these retained earnings?
Yes, sir.
Retained earnings at reporting minus retained earnings. But sometimes you have to use the ending figures here, because this is what we are sharing. Yeah. So that is the same thing. So you realize that when we wanted to do this one, we use the net asset to find the retained earnings. The same thing. So the same thing you do is not different. There is no difference. So this one was given. So you did 80 of 35. 20 of the 35. You had 7. So what is this one? $80 of the 35 will give
28.
28.
28, sir. Yeah.
All right, good.
Yeah,
now let's
28.
do this side. Retained earnings at the end of that guy is 94. At reporting, it's 94. He stayed at reporting. But what is the retained earnings at his acquisition? You may have to go and work it, just like we work the other one. So work it. So that one too, we will need his stated capital. You need his stated capital. It didn't change. Nobody issued anything. Stated
200.
capital 200. Share premium
Plus share premium 30.
30. So you see, they gave you the fair value of net assets when they were buying this guy. Have you seen it?
Yes, sir.
200.
Yeah.
They gave you. So it means that you have to be mindful of any fair value adjustment, if any, before you get your retained earnings. I think that they told us something about this Chebi man. On 1st April 2016, the fair value of Chebi's land was 60 million in excess of their carrying value. There has not been any such. It means that at the time that they were buying, there's a fair value adjustment of land. Adjustment of land, which is 16.
Yeah, 16.
So what would be the retained earnings at end? What would be the retained earnings? Andy, were you able to do this side like that? Were you able to discover it? Because you said you tried the question. Were you able to discover it like that?
46.
I think Andy has left class. All right. You had what?
46.
Positive or negative?
Hello, sir.
Were you able to uncover this part?
Sir, my network dropped. I didn't hear the question.
No, I'm asking, were you able to do the investment in associate?
Yes, sir.
What did you get there?
91.
91. Okay, so let's find out. So what do you have?
So 46. I had cost of.
What is the retained earnings?
It's 46.
Are you asking me?
Is it positive or negative?
Negative.
It's negative.
So 46. Which means it's a loss. So it means here will be minus. Have you seen that?
Okay.
Yeah. Negative.
So it makes this side positive. So now 25% of that is what?
T.
35.
It's what? 35. So Andy said he has 91. It's actually 95. 95. So that is that. So now you know that here, see, so you saw what you have. And if you know your console associate very well, you know that this thing that you do, this one, post-acquisition, it's also part of your workings 5. You will bring it into the group here. So CI share of post-acquisition associate. You highlight associate. You are picking it from working 6. So the 35. This thing is from basic console, like it's basic level 2. Like that is how it is. That is how it is. So the investment in associate is 95. So quickly, you don't waste time. This thing.
Hello, sir.
Yes, please.
Sir, You said you had 35.
I had 35, not you. That is what we had. I don't know
So
what you had.
what I did was there was initial 200 CDs. If you go to the question, the 25%, acquisition, the fair value of the net assets was 200. So I added the fair value adjustment of land, which is the 16 CDs. Then
No,
I
but that's
got
the same thing that we have
the
done.
total.
Did you consider the share premium of 30?
Then come again.
What you are saying, that's exactly what we have done, but you've not mentioned the share premium. There was a share premium of 30. You said, what did you do?
Oh, okay.
You said you
Okay.
picked this
So
200.
I didn't add the share premium. So I got 216. Yes, plus the 16. I didn't add the share premium.
Why won't you add share premium? It's part of the associate figure. The fair value of the net asset is this 200. That is it. The net
Yeah, we are
asset.
talking about Chebi. We are talking about Chebi, right?
Yes, please. So you said, what did you do? What did you do?
So the reporting was 340. So I deducted from the waste. I got 124.
Hold on.
Then I took
Hold
the
on. You stop rushing. The reporting was 340. Where is the 340? Where did you pick the 340?
okay, so the 200 and then the 30 plus 94 plus the 16.
200 is 320 plus which 16? The fair value adjustment. So you said you
Yes,
did
please.
200 plus
30 plus 94 plus 16.
which 200 is this? Is it
Come
this
again?
one? Which
Yes.
200 is this?
The
Because there are
the
so
share
many 200. So which 200 is that?
so the share capital of Chebi.
But you said you didn't use the share premium. So, but this is the share premium. If you didn't use the share premium,
Okay,
then
I will look at it later on. So let's continue.
all right. So now this is what we have. So investment in associates. So it's 95. So we've brought, just bring your 95. Invest. Hey, I wrote 35. Imagine
Yeah, it's 95.
95. So it means this place is complete. So guys, get us the balancing figure. Get it for us. Total it and get it for us.
2591. Someone can also confirm 2591.
I will need confirmation. It's very important. 2591. Okay. Then let's complete this side. We are left with our retained earnings. I think that's the only thing left. So let's complete our group retained earnings workings. So what hasn't come yet? CI share of impairment, right?
Yeah.
Which is 80% of, what was the impairment? 15, right? 80% of 15. 80% of the 15. So what do you have? What do you have?
Yes, sir.
Then
I'll be
the
12.
is 12. Then the loss
Yes,
on
please.
you can decide to bring in the loss, that loss of 3. Now,
Okay.
here you can
Yes,
decide
sir.
to bring in the 33 and the 30, whichever way you want it. Or you can decide to bring the net of 3. Is at the, so that is that. So loss adjustment on the associate. So the loss on associate disposal. All right. That is -3. Is that all? Is there anything we've not considered? Is there anything we've not considered? We have done the post-acquisition sharings, we have done the losses, we have done the impairment.
So the impairment, you put it into brackets. That's all.
Yeah, it has to be in brackets. It's an impairment deduction. I think that's it, right?
Yes, sir.
So what is the total? Then you just go and slot it in there and you check your balancing. If you balance, fine. If you don't
438.
balance, move on. 438.
Yeah.
If it doesn't balance, move on in the exam condition. Don't waste time. If you have, you have 30 minutes to solve a question. When you finish, then you can go over for 6 minutes to 10 minutes. No one question should exceed 40 minutes. No 20-mark question should exceed 40 minutes. If you know you are being over 40 minutes, stop and move on. What's the figure? 438. So
438, yeah.
let's push it in and see what we have. Yes, Andy Rate, your hand is up.
Sir, the non-current liability is 670, not 690. The
It's
640 plus 30.
670, yeah? This one.
Yeah.
Thank you very much. 670. All right. So total the equity side, there should be something. This side there should be a 1 that is appearing. So this side should so balance. This side is 7, right?
Yes, sir.
Something 7. Total it because with the 7 plus 4 here will be 1. Total this side and let's see. But if it doesn't balance,
It's 1577.
77.
Yes, sir.
All right.
So when you add, you get the 2591.
2591. But please, like I'm saying, if you are in exam condition and this thing does not balance, move on. Please move on. If it is beyond 40 minutes, move on. Don't waste time. It is ticks that is needed. I can solve this same question and balance it another way correctly, not with these same balancing figures. So move on because we don't mark this one. This one is not marked.
Yeah, but mine too balanced though.
Well, when we ask,
I use the 91.
So that's why Isa is saying that he can do it another way and have.
Yeah. Oh, there are so many ways I can do this
balance
because of the the thing. You can do it, but you see, then it means that if you had 91, I can see what you did wrong. Because you didn't factor in this 16. That's the meaning. You didn't factor this 16 as part of the fair value adjustment when you were determining because if I do 25%, 0.25% of the 16, it will give me 4. That 4 is what you didn't do. That 4, if you like, check. That 4 is what you didn't do here on the associate figure. That's why you had 91. You didn't consider it. That 4 here. This fair value adjustment, 25% of this, you didn't consider. That is what will give you this.
Okay. Okay.
So the console can balance all the time. Console can balance. I mean, there are 10,000 ways of balancing the console, but you will lose the tick for this side. You will lose it. That's all. That's it. I can solve this thing.
Repeat what you said again. I'm interested. Repeat what you said again.
Which one?
That's for that 16 way. I should have calculated the Cheby's 25% portion of the fair value adjustment.
Of course, there's fair value adjustment. It means your analysis, you never factored in the fair value adjustment, but there was fair value adjustment when you were buying Cheby of a land, 60 million.
Yeah.
It wasn't factored. If it's simple, do 25% of the 16, you will see it's 4. And that is the 4 you didn't factor. So your here will be 31. So it will balance, of course. If I decide not to treat this 46 at all, or I mean this 35 at all, here will be 60. This one to reduce by 60, which means that my asset, if I don't do this 35, my asset will remain 60. investment in associate will remain 60, then this part will also not come. So that one will be reduced by the 35. So it will still balance. I mean, that's it. But at the end of the day, the ticks, you will lose ticks. That is why we keep telling you that don't focus on balancing the thing by force. You are wasting time. Get as much as the ticks that you can get. You move on. So this is how this question, and so please, now that this question has been dealt with, you've seen this. So you should be able to solve the question 7. You should be able to solve the question 7 as your practice. All right. The question 7, what they did was that they decided to bring in IAS 19 inside it. So the same person who said the question can now repeat this one, now not bringing in IAS 19, and repeat this exact question. That's it. That's it. All right. So ladies and gentlemen, this is a step acquisition, a typical example of a step acquisition. All right. Now, we have another question to do as part of our rehearsal.